In this video, I'm going to talk about the best trading pattern for new traders. Stay tuned. Hey traders, a very warm welcome to you. So if you're a brand new trader, what is the best trading pattern? Well, I have a few that I think are good. However, I'm going to give you just one. The one trading pattern, setup, whatever you want to call it, that I think is the best one for a new trader. And it is, you may have heard of it before, it's nothing new, it's not proprietary or anything. It is the flag pattern. Why do I say the flag pattern? Because I think it is one of the best patterns out there. It's not only simple, the risk is quantified, it's got good potential. I still take them to this day regularly under the right conditions. I love a bull flag or a bear flag. I think it's one of the best things that you can get. So let's discuss the pattern. So if you're trading on, it works on all time frames as well. That's the beauty of this thing. And the reason it works also makes sense too. So let's discuss it and talk about it. So the flag pattern is this. A classical bull flag will look like this. And what is that? That is price moving from there, from that level to that level, and then price just sitting in this tight range at the top. And the reason it's called a flag is because this bit here is your pole and this bit here is your flag. Now, that's obviously a very structured way of looking at it and kind of very symmetrical. It may not always look like that. The flag might be sloping down slightly. In other words, you know, it's sloping like this way. You might have a pennant, which is a little bit different, kind of going to a point. The point is, the point is that price action has moved from one area to the next. And it's going to be flipped around for a bear flag. It's moved from low to high, and it's holding in the top chunk of that move. That's the key to this whole thing, is that now people are perceiving that this is a new level of value. They're saying, okay, we've moved from here to here very, very quickly, and now we're holding. And the theory of this trade is that you're going to continue in that direction. When you break this flag, you're going to continue upwards, and then you're going to make money out of it. So the idea is you go long, you buy at some point here, looking for a continuation. So let's drill down into the flag and let's see how we buy the flag. So assume we've come up and now we're in this scenario, the flag scenario here. We've got a top to the flag, we've got a bottom to the flag. What are our options? Well, option number one is that we can buy on a break of that flag there. So as it breaks the high of that range of the flag, we go long, and our stop is going to be put underneath the bottom of the flag here. That's our stop loss. Very, very simple way. So this is why I like it, because it's simple. It's a simple rules to it. You go long here, you put your stop there. Your total risk that you're prepared to take on a trade, have in pounds value, dollars value, euros value, is divided by the distance of that. That gives you a position size. Very simple to calculate. Targets wise, you can be flexible with this. Some people say the distance of the pole is a target. So if that's moved 50 pips, you look for a 50 pip target. Some people say half the pole and extrapolate that out. Play around with it. You know, you can just use a systemized strategy where you just take twice your risk. There are ways to do it. The point is, if this is a genuine momentum play, this will continue on and on. So that's one way of getting involved in it. The second way of getting involved in it is, if we have, let me just do this, is you buy on the bottom of the flag. So in other words, you buy here, or you wait for it to break through the low of the flag, come back up into the flag, and then you buy it as it comes back up into the flag. So there's a couple of ways there of doing that, or that bottom way. And the same kind of thing, if you're buying at the bottom of the flag, you're going to use a fixed stop in points based on your risk parameters for your trade. So if you're buying there, you're going to use, say, like a 20-point stop, and you're going to split the position size up into that. And again, be sensible with it. You know, maybe you use the half the flag width as a stop and extrapolate that out. That's not a bad way of doing it. Or if that's really tight, whole flag width and put the stop the same level underneath it. Whatever it may be, you know, use some common sense with it. If you're using the play of, I'll redraw this for you guys. If we're using the one where we break through and come back up, and you're taking this break through, very, very easy to quantify the trade, very, very easy to place your stop. You're going long as you come back through, and your stop is going underneath the fake out low. And then if you want to, you can take out some of the trade scale out some of the trade into that high, or you use the same strategy here as a percentage of the flagpole as your total target, or a gap fill, or a resistance level. Don't want to get too complicated, but that's the theory of the trade. Very, very simple trade to use, very, very simple trade to execute. Works beautifully on a daily chart as well. You've had a day, you've had several days of move, lovely move up, holding at highs. You're getting this kind of flag pattern. You're looking for continuation. You can buy at the end of the day, or you can set an alert, or you can set a stop entry to get in. A stop entry will get you in if a specific price level is done. It works beautifully intraday as well on like a 1 minute, 5 or 15 minute. Again, the point is that the supply demand has shifted. It's moved up in one direction, and now it's an equilibrium. The flag is like doing this much into the seesaw, and then you're looking for it to shift again back in the same direction. And it's identical to a bear flag, guys. I'll just draw the bear flag for you quickly, but it is exactly the same thing, just in reverse. Be aware that you want to be generally in a bear market condition or a downtrend in a longer time frame to take a bear flag most of the time. There's no point taking a bear flag when the last 4 or 5 days have been up and then you get a little bit of a down move. That's not really a bear flag. Same kind of thing. There's your pole and there's your flag at lows. And again, you're just looking to do exactly the same execution process, either breaking through the low of the flag, trading on the high range of the flag, trading the breakout of the flag. Good pattern, guys. I use it regularly. I know many traders who use it. It's a really powerful, good pattern under the right conditions. You need to make sure you're in the right environment for it. Don't take it in the middle of a trading range. Make sure that you have had a good move. This pole is a decent length. Your scale, you're not kind of looking at a scale and it's actually deceiving you. It's only really 10 ticks. Got to be a good drive move, preferably on good volume as well. But we can add more parameters into that. But basically, in simple terms, the best trading pattern for new traders, in my opinion, is the flag pattern. What do you think is the best pattern for new traders? Let me know in the comment section below. And if you like the video, give it a thumbs up. Take care, guys. See you in the next one. Goodbye.